JDC West 2014 Finance Case Presentation, proudly presented by Intact Insurance. Thank you to our judges, Rob Bremner from the Richard Ivey School of Business, Lorelei Johns representing CPA, Sylvan Renault from Intact Insurance, Brad Restall from EMCO, Blair Swiston from Crown Investment Corporation, Mike Van Ellsberg from Intact Insurance. Competitors will have a maximum of 20 minutes to present. Immediately following the presentation, judges will have a total of 5 minutes for questions. I will show time cards at various intervals to indicate the remaining time, and will stop any speaker who exceeds the maximum time limit. No questions, comments, cell phones, or picture taking will be permitted from the audience. The audience will only be permitted to applaud following the question and answer period. The audience is banned from any material that bears the name or symbol of a competing university. And we ask that the audience immediately exit following the question and answer period. Competitors, you can start there.
Good afternoon, Mr. Conrad, and thank you so much for coming out today. Over the past few hours, we've been hard at work examining your company's situation, specifically regarding the investment opportunity of the Zane Real Estate Investment Trust. So essentially our objective today, or our goal today, isn't to share facts with you and share numbers with you. Our goal is to share our specific insights and our perspective on these numbers and to make sense of the situation to help you come to a recommendation about your strategy moving forward. So jumping right into it here, what are the two main questions that your organization currently faces? The first is investing in real estate investment trusts a strategic fit for your organization specifically? We actually recommend that it is a strategic fit, and let me tell you why. The first is that we believe that regulation reduces risk. Your organization doesn't take on too much risk and has moderate returns. So we do believe that that's one of the reasons why it's a strategic fit. The next is that there is healthy returns for your unit holders. And then finally, it gives you an ability to diversify your portfolio. And then the next burning question is the Zane Real Estate Investment Trust specifically a good buy for you? And our recommendation is absolutely. It has healthy historical returns of 13.6% and 22% respectively over the past 2 years. It is also low risk, so there's a contract clause within the trust that actually guarantees revenues from the different organizations that it leases their properties. And then finally, and this is one of the more important points, it is, as I alluded to earlier, a great strategic fit for your organization. So I will be walking through some of the situational analysis, and then I'll hand it over to Diana, who's going to take a look at the strategic alternatives as well as the financial analysis. And then we'll pass it over to Tyler, who's going to finish off with the implementation and the ever so important risk mitigations. So the industry, it's extremely important to understand the industry that you would be investing in. And so what we thought was extremely important is, and we've highlighted a few of them here, is typical real estate investment trust clauses pay out between 70 and 95% of earnings. As you'll see later on in our presentation, this one pays out 65%, and we'll talk about the implications of that. But the implication of that one specifically is that this can be used to entice investors to the real estate investment trust, market. The next characteristic is that there is a real estate boom in Canada, and it's been the same over the past 10 years. And what this means for your organization specifically is that you have an opportunity to invest in a Canadian market that's been steady over the past 10 years. The next characteristic is that the U.S. market is currently showing signs of recovery from 2008. The opportunity here for JDC specifically is to try to communicate to shareholders that it might be a good idea and a great time to further diversify into the U.S. market. The next characteristic of this industry is that these trusts actually all the gains on these trusts are not taxable. And what this means is that if you invest in a fund like this, you can actually entice further investment and say, hey, listen, there is no, all the gains all the capital gains are are not taxable at all. And that's extra money going into your unit pocket, your unit shareholders' pocket. And then the next characteristic is that there's low vacancy rates in Canada and the US right now. So what's the implication for the Zane Fund specifically in your organization? It means that investors can be confident that there's going to be a continued demand for real estate space. And then finally, so these funds are governed by investment guidelines. And people, as of 2008, are a little weary in terms of investing in the housing market. And what this means is that they can actually become more confident because they realize that these guidelines are managing the risk that shareholders are susceptible to. Bottom line, the real estate investment trust industry is an attractive investment because of its tax benefits, US and Canadian real estate trends, and finally, its low risk. So essentially, who are the stakeholders, what do they require? The main stakeholder is yourself, Mr. Contact, and what you require is the ability to run an ethical company that satisfies your unit holders and their interests. And then next is the JDC unit holders. And what they require, and that's strictly based on whether they're fixed income or a Canadian equity investor or both. But essentially, they just require a capital gain on their investment or a healthy supply of capital. Bottom line, by investing in the Zane Trust, JDC is upholding the values of their company strategy, and they're also satisfying their shareholder interests, or their unit holder interests. So what we wanted to do here was take a look at an external analysis, an internal analysis of Zane. So we took this SWOT analysis from the perspective of Zane because we wanted you guys to know, your organization to know where you're investing and what you're investing in and what that means for your organization. So the first strength here is that this trust, the properties in the Zane investment are diversified across property types as well as geographic regions. The next is that it's publicly traded, which means that there's certain disclosure requirements. And then following that is the fund is actually expected to generate stable cash flows for investors. Unit holders, like I alluded to earlier, are actually exempt from any tax on the capital gains they receive. And then finally, it's low risk with a beta of 0.71. Bottom line, unit holders of JDC will be open to Zane Real Estate Investment Trust because of its low risk, return potential, and shelter from tax. Moving on to the weaknesses. Like any trust, there is going to be weaknesses involved in this investment. So it's not diversified outside of the retail of the real estate industry, but we're not entirely concerned about that because of the regulations and because of the things put in place that we alluded to earlier. And the next weakness is the payout ratio of 65% compared to the industry averages of 70 to 95%. And then finally, it's not backed by assets. So in an event, which we think is extremely low probability, that the trust does go bankrupt, there's no assets that shareholders can claim. But again, the probability of this is extremely low. Bottom line, unit holders of JDC receive a lower cash flow from the Zane investment versus the industry averages. Okay, so moving on to the opportunities and threats here. So I've shared the strengths and the weaknesses, but let's talk about the opportunities. There is an opportunity here to capitalize on the rebound of the U.S. housing market, and you will successfully do this by investing in Zane. The next is this continued trend of the Canadian house market. So we've been fortunate enough to be situated in a stable country with regulation that ensures that our housing market doesn't fluctuate and isn't as volatile as other countries. And then moving on to the threats, future economic recession can put downward pricing pressure on rent. In short, what this means is that Zane receives its cash flow from renters, and if there's a downward pressure on rent, that means that they're not receiving as much revenue as they would in a different economic situation. And then finally, the market, as I alluded to earlier, is a little weary of investing in the housing market, especially after 2008. So we want to answer, and we will answer this further on in the presentation, but how can you mitigate this? And Tyler will jump into that. But bottom line, JDC must educate investors on the benefits of investing in this trust as well as capitalizing on the rebound of the US market. So how does JDC go beyond profits? So what we've done here is essentially broken this up into three different categories: ethical decision-making, economic sustainability, and finally, oh wait, I might have to skip through environmentally conscious. Okay, so that's the third one. For ethical decision-making, this is a quote taken directly from Mr. Conrad, and it was, "Success isn't measured on profit alone." And what we determined is that because of hefty, in 2008 specifically, because of hefty bonuses, managers and investment bankers were incentivized to increase their profits by investing in high-risk, high-reward investments, but that wasn't necessarily satisfying shareholder interests. But what your company does, and what we hope to see that your mission will be moving forward, is putting a concentrated effort on hiring and retaining individuals who are primarily concerned with unit holder interests in mind when they're making their investment decisions. The next is economic stability. So essentially what this talks about is the fact that your organization, the fact that your company performs a thorough due diligence on each of their investments, and this is the reason how they ensure, and this is how they ensure economic stability, making smart investments and ensuring that unit holders are always satisfied. And then finally, environmentally conscious. So we weren't provided with the information, but ideally what we'd like to see for your organization is you taking a proactive approach in investing in socially conscious companies. So how can JDC Investment grow its assets under management while retaining their strategic objectives? At this point, I'd like to pass it over to Diana, who's going to walk you through some of our financial and strategic analysis.
Thank you, Ali. After analyzing the environment that you're operating in, now we would like to take you through the analysis of the key issues that we have identified for you. So first question we want to answer for you is whether or not REIT is a strategic fit for your company. And secondly, whether or not Zinc is a good buy. So a comprehensive evaluation of those key issues will form the basis for our recommendation. First, looking at the real estate investment trust, if you do decide to invest in the trust, you have the advantage of, if you do not invest in it, you have the advantage of investing in some other sort of security, such as a Canadian equity. And you can continue your expertise in your current holdings, as we can see you're currently doing very well. If you do decide to invest in this trust, we can see that it gives you even more advantages, since it fits with your strategic direction. The real estate investment trust invests primarily in Canadian real estate and also has a low risk because it gives you regular cash flows from their income. The industry average right now is 70 to 95% of the income. So it is very attractive and it has a low risk because we can see it's a steady cash flow. And in addition, you'll be able to benefit from capital gains. Also, we can see that this trust is more resilient to short-term economic conditions. So it will even lower your risk even more. And also it is governed by trust indentures. So what that means is it has clauses on how much return you will get. And also it limits how much borrowing that these companies can have. Bottom line, we recommend that you invest in REIT as it does provide a decent return for a reasonably low amount of risk. And it is aligned with your strategic direction. Next, we want to look at a company that you have been following for a long time, and that is the Zinc REIT. And for the valuation of this company, we will look at three different valuation methods. The first one being NAV, the net asset value, FFO, funds from operation, and dividend discount model. Now, I would like to draw your attention to the weighting of these methods. For NAV, we have placed a weighting of 30%, since it is looking at the difference between the property values and your liabilities. So we think it is a very good market value consideration. And for FFO, we give a 70% weighting, since it measures the cash flow. So it is projection of the future and takes into account of a lot of categories. So it gives you a good valuation of the firm. And for this dividend discount model, it is a good model in some firms, but in this case, we give a weighting of 0%. assumes a constant growth rate. For example, for this year's growth rate, it assumes that it goes in perpetuity for a long time. And so for our recommendation today, we've given 30% and 70% for the first two methods. And you have given us some information on your industry companies. And we have chosen Ryokan, Callaway, and Allied Properties for our calculation, since we feel like they are the most closely related to your company, and they're in the similar price range. We have taken the average ratios of these three companies and will be applying it to Zane. The first method we look at is NAV, and as we can see here, the average NAV of the three companies are 2480. And because the NAV implies a price for the company, the implied Zane price will be 2480 per unit. The next method we look at is FFO, and by taking the average price over FFO ratio of 1578, we multiply that with Zane's FFO to get an average price of 2429. So using FFO comparables, Zane is valued at 2429 per unit. The last model we look at is a discount dividend model, and with this, we found an annual growth rate of 4.24% using the growth rate that you have given us. And with that, we also calculate the CAPM from risk-free rate beta risk premium that you have given us. So the CAPM will be 5.26%. And using the discount dividend model, we have found the price of Zane to be 137. As you can see, this is a big difference from the previous two valuation methods. And that is why we have used only the first two methods to come up with the valuation of 2445 per unit for Zane. Now, we want to look at whether or not Zane is a good buy. In addition to the quantitative, we also want to look at the qualitative qualities. So if you do decide to not invest in Zane, then you have you avoid the low payout ratio of Zane compared to the industry average. Since you can see in the index, the plowback ratio was 35, so the payout is only 65 compared to the industry average. But however, if you do not invest in Zane, you'll have a lower diversification, and you'll miss out on this great undervalued security. If you do decide to invest, it'll give you those great benefits, such as no tax, all income, opportunities for capital gains. But most importantly, we feel like because it is undervalued, you should take advantage of this opportunity. Bottom line, you should invest in Zane since it is a great undervalued security. After going through our recommendations, I would now like to pass off to Tyler to walk you through how you could implement this strategy.
Thank you, Diana. I'd just like to start off by reiterating my colleague's tone and saying how excited we are that we are able to give you this recommendation. And we strongly believe plans under implementation will be the difference between good and great for your investment fund, and they will separate you in this industry. Just due to the matter of time constraints, we'll be happy to talk to you about things later. I'm just going to give these over to the implementation. So short term, that's a time frame of 0 to 12 months. We recommend that you perform your final due diligence on Zane and extensive research on comparable funds just to get a feel for the industry. And we recommend that you issue an open letter to the unit holders of JDC, just to let them know that you have this awesome fund and you are very excited to make them a part of that. And as we know, lots of the larger shareholders in the company are right in line with this investment. Moving on to this is still a short term, so it's still 0 to 12 months. We recommend that you do, of course, invest in Zane and prepare those necessary documentation and notify those shareholders. And moving forward, as Aline mentioned with the Beyond Profits theme, we recommend that you evaluate funds and firms to fulfill those environmental objectives moving forward. Moving on to long-term implementation, that's a time frame of 1 to 5 years. These are more general strategic things that you can do with your fund as you move forward. We recommend that you continue to monitor the fund that you just invested in, continue to monitor their asset drivers, so these are the economic factors that affect them, such as the housing market, regulation on rent, tax benefits, etc. And finally, diversify the JDC investment fund. In the information you gave to us, you explained that this was the Canadian-only fixed income investment was the step 1 to your great plan for this. And we understand, due to your past experience, you want to keep the risk rate low, but we understand also that moving forward, we would like to see you invest in further securities. Moving on to risk mitigation, we identified two major risks for you. I'll just go over them quickly. First one is future economic recessions, putting a downward pressure on rent. Aline described that earlier. And also the market is wary of real estate industry because of 2008 recession. And that is very important because as we've noticed in past trends, over time, the housing industry is a precursor to economic recession, so it's very key to keep an eye on that. As you can see from the slide, our plan, the outcomes have satisfied all the stakeholder benefits, and we are very extremely excited about that. Moving on to the executive summary. First of all, we recommended that yes, investing in the real estate industry is a very good recommendation for this trust that you have set up. And also, Zane is a perfect fit for you, and we were very excited about that. In summary, I would just, that's our recommendation for you. By following our recommendation, you will achieve success beyond the bottom line. You'll be strategically positioned to reach all the goals you've set out for yourself, both in the short term and for many years to come. And we are extremely, extremely excited to see you reach those goals. On behalf of my colleagues, I'd like to thank you for your time and now open up the floor for any questions you may have.
Do you have any recommendation on percentage of the portfolio that should be invested, where those funds should be allocated?
So I can have that question. So from the information you provided to us, there was not recent information from the side of your investment portfolio that we could credit to understand the diversification that we should apply to it. But taking into account the economic boom and bust cycle of the housing market, we recommend that you invest a healthy amount while accounting for different securities that can compensate for that cycle.
Should be better define healthy amount of percentage of the portfolio.
I mean, it's tough. At this point, if we gave you a percentage, it'd be an arbitrary number because we don't know the current breakdown. So if I recall correctly, there's about 70% invested in the TSX, and then there was 2% invested in the treasury bills, and then the rest of that, the remaining 20% is in fixed income. So at this point, we would define a healthy percent as 25, is about 25% to balance out not necessarily volatility of the equity, but in order to satisfy the fixed investment strategy. That being said, though, that's something that we have to sit down and run more analysis on. So that's why I'm not as confident to say 25% of the healthy.
Why did you choose to weight funds from operations heavier than asset value?
Right, so we decided to give FFO a weighting of 70% since we do think it takes into account of a lot of factors such as revenue and expenses rather than just looking at the property value alone.
Okay, how do you think those property values are defined? How do you think they come to the net asset value?
Right, so for the net asset value, we believe that because it is real estate investment fund, they look at the properties that they are holding in on. And with that, they compare to the market value. And they also subtract their liabilities to find out the differences.
How do they find the market value?
Yeah, I mean, we'll be on more of that.
So, I'm going to quickly talk about the value chain to answer your question of how they find market value. So, the Zane Trust Fund essentially buys properties and then leases them. So, the way they get their market value is that they determine the rent expense that they're receiving on their properties and what the market value for a similar property would be on the open market. And then that's how they get their net asset value. Sorry, is that answer your question?
The payout ratio was only 65%, which you point out is lower than the rest of the directors. So what would the Zane Trust do if the capital doesn't pay it?
Okay, so the 60, I would like to address two things. I'd like to address the 65% and why essentially it's still a great opportunity, and then address your second question of what would they be doing with the remaining, the plowback of 35%. First and foremost, 65%, we still believe in it, we still believe it'll entice people. The reason is, real quick, is because of the clause that has guaranteed revenues. And then to address your second question of what they would do with the plowback. So that, in terms of what they will be doing with those extra funds, there's certain administration fees that they have to cost. They do, we imagine they do extensive research, so that's covering the cost that they incur, especially by taking on that guaranteed revenue